Hello everybody, welcome to TraderMerlin Show. It is your Monday edition, our final week of shows for the year. We know we'll be taking next week off for the holiday week, and then this will be a short week. So we got 3 shows left for the year. Hope you all had a great trading session out there today as we get the little bit of a market sell-off from nobody pushing Tesla up any higher. So we'll talk a little bit about Tesla today. Topic du jour, well, that's going to be this, the big picture. We've got a twofer today. I'm working on my technology on my end. We actually managed to, hopefully it works, but right now we're slated to have Mr. John O'Donnell and Mr. Mark Thornton joining us today. Gentlemen, how you doing?
Merlin, doing great. Good to be back on with you.
It's been quite some time. I think last time you were on, we were actually on a different format. How are things going down there?
Things are going fine in Auburn and in Alabama. The lockdown is not very severe. However, the students at the university, a lot of them came back to school anticipating classes, and it was all online basically.
Yeah. Well, I tell you, it's a far cry different than rush week when I went to college. That's for damn sure. No collegiate parties, no keggers.
Speaking of lockdowns and change of behavior, I saw a report this week indicating if you're a business person and you haven't digitized your business model and figured out a way to serve the customer or the user digitally in an interactive space, we're not going back to the old normal. That this behavior on college campuses, maybe even above private educators. I know Online Trading Academy has taken a big effort in teaching online live synchronous and asynchronous delivery of content, and that when things do return to hopefully normal, what we consider old normal, that this is just going to be perhaps a permanent or semi-permanent change in the delivery of goods, specifically services. What do you think about the potential of that, Mark?
Well, it's hard to say. Most of the services that I use are up and running by and large. And with the university, I've interviewed students and I've interviewed professors, and they do not like this online learning for them. Now, they'll do online learning for specific things, but for the college experience, they really miss it, and there's kind of a disconnect that they weren't anticipating because this is such a shock. So is it a shock that goes back to normal, or is it a real turn? I think that depends on the business.
Yeah, and I mean, I've actually talked to a friend of mine today, and he was saying that at his kids are they're in Utah, and said both of the schools are operating as normal. And of course, I'm out here in California when we're on lockdown. I can't even peek my head out my house without someone looking at me all weird. So definitely different strokes for different folks. On the macro level, I know we could look at the economic data, which in my opinion is going to be completely skewed by the stimulus packages that are going in. I'd like to get your thoughts on the latest round, which gives us, $600, gives some people a $600 stimulus check, which, to be honest, is like my bar tab for a month. But I wonder what your thoughts are on the $600 stimulus check.
Well, there's a lot of people that are hurting out there. In the private sector, charities are all trying to help. And I've noticed a lot of people in my daily circle are reaching out to help people. But at the same time, that money's going to come in, it's going to go out, and we're going to be another $1 trillion in debt. Mm-hmm. And that's the real long-term problem for the U.S. economy, is that the amount of debt that's been accumulating far, far outweighs economic growth that we've experienced for the last couple of decades. And so our ability to pay the debt is going down, and the amount of debt is going up. And if interest rates rise, the interest payments are going to be pretty much unbearable. So that's a much worse problem, basically, than the problem that is being addressed by the stimulus package.
On that note, we talk. You mentioned in almost an insurmountable amount of debt. and just the how do we facilitate that debt, right? I mean, obviously I had the debt clock up here for the viewers out at home. You're looking at U.S. national debt. I don't even know if this includes the new stimulus package, but it's, $27 trillion drop in the bucket, about $83,000 per citizen. Oh, but don't worry, folks. You got yourself a $600 check coming. No big deal. What's your thought on the path that we're headed? Because we could look at chart after chart after chart showing, for the course of time, the amount of debt in the U.S., and that spike, that Mount Everest of debt that's incurred really, starting in 2007 and 8 was the real big spike, but all of a sudden 2020 we've gone absolutely parabolic to a chart that would make a Bitcoin fanatic drool even. What's your thoughts on how this ends? Because as it seems like our politicians anywhere are just drunk off of the debt bubble and not worried about it. And to me, I think that there's cause to be worried.
There is cause to be worried. There's no question, Merlin. And, but everything's been taken off the table. There's no more deficit hawks in Congress. We have elected a very liberal legislature, and it's going to be in the control of the Democrats. They're not going to want to do any budget cutting that's really necessary to get this under control. You can still get it under control, but the problem is there's no ideological pull to get that job done. So the media is really off track on this. Government itself and the legislature is off track on this. And so that's the real problem. That's what we're trying to get people to focus on is what's best for long-term economic prosperity, and it's not the government going into a lot of debt. We have seen in recent months that the consumer has pulled back on additional borrowing and has actually paid down a noticeable amount of credit card debt, and that really surprised me. So people are starting to get the idea when they can in their own lives, but that has not gotten through to Washington, D.C. at all.
Yeah, and one of the challenges here is when you look at historical administrations, there's a chat here, comments basically from FX Green says, cut the government spending. Historically, that is a Republican Party initiative. You don't really see that too much with Democrats. And, now, you could make that argument because historically, we know that the markets return better under Democratic administrations, which is bizarre, but I believe a lot of that has to do with the tax money now going back to infrastructure projects and growing it. Now, if we're all in lockdown and can't go out and build and do things we would normally do, you're kind of entering that fight with one arm, so to speak. So it's a bit of a challenge going forward. How do you see this incoming administration or handling things, or I guess maybe what their big challenges might be? Because the list seems to be very long.
It is very long of the challenges of their proposals. Joe Biden is thought of as a moderate Democrat, but he's really been won over by the progressive wing of the Democrat Party, by Barack Obama, and his willingness to intervene and spend and regulate are seemingly unended right now. And he's willing to go along with things that in the past he wouldn't be willing to go along with, such as more gun control laws, for example, in a non-economic manner. So that is not a good sign going forward. Especially if the Democrats get control of the U.S. Senate, that really opens up Pandora's box, and it's really going to push the Democratic Party to reveal itself. Once in control, of course, the progressives are going to want to see a lot of their wish list addressed, and that brings them in conflict with the more moderate Democrats in Republican states, and whether or not they're going to be willing to go along with those kind of measures. For example, Democrats in farming states are not going to want to see the end of the Electoral College. So, if they do get full control, it's going to be a battle within the Democratic Party rather than a battle between the two parties.
John, what do you think? I know we've got, obviously, I don't want to go too political here, but obviously there's changes coming. And one of the things that markets do not like is uncertainty and change. And as we transition into this new administration, what do you see as the major impacts?
Well, I think it's going to be the greatest question. I think it's the $64 billion question. Is Biden really a moderate? Historically, he seemed to chirp in that direction, but he's not the same person today that he was back during the Obama administration. And there are, on the hard left, there are a lot of political winds over there. They're putting a lot of pressure on him. Take a look at some of these cabinet appointments. So I really question, is he going to rule from the center? If he does, and if these Republicans can keep control of the Senate, we have a better chance of gridlock. And historically, gridlock's been pretty good for markets.
Mm-hmm.
But I think the real question is, what kind of pressure is going to be put on Biden, and how's he really going to intervene? Are we going to have socialized medicine? Are we going to have is this infrastructure program just going to be another boondoggle? I remember when Trump was talking about a lot of infrastructure that never came to be.
Well, so was Clinton. I mean, that was the main platform, because I think if you look at the infrastructure issues, this is what I think would really help us out, right? It's jobs. It's the creation of jobs. It's improving America, et cetera. But you're right. Not a lot has happened other than building a border wall, which of course Mexico paid for. But I don't see much changing. It's just talk at this point.
Yeah. So, let's I don't know, give him the benefit of the doubt, but given his track record, and given the pressures that he's under today, I think Mark's spot on talking about this upcoming Georgia revote.
Mm-hmm.
This is going to be critical to have some semblance of a check and balance. If the Democrats are going to give him a blank check, and Georgia has historically been a red state, but if they're going to give him a blank check, I think the spending is going to go crazy.
Yeah.
I mean,
well, hey,
that's my personal opinion.
It could be good for the economy. All right, we got presidential shift, obviously, and Mark, you've talked on Power Trading Radio in the past about this, which is the topic of drugs and prohibition. Obviously, we see the barrier to cannabis and marijuana kind of falling more and more. One of the things we talked about in this show when I did my presidential election show was how if Biden were to win, the gateway to legalization of cannabis on a federal level, which I think would be massive for business and for government taxation, would be huge. But you also saw in Oregon, legalization of going one step further and talking about some psychedelics and other drugs out there. I'd love to get your take on what you think that means for our markets and maybe the economy going forward.
Well, there was already a movement in Washington, D.C. To liberalize the federal government's posture towards cannabis and even other drugs. And so that's already a good thing.
Mm-hmm.
And I'm got my fingers crossed, because Joe Biden had long been a drug warrior of the worst sort. And Kamala Harris is also a drug warrior of the worst sort, willing to throw cannabis smokers into prison for long periods of time. So I've got my fingers crossed that they're not going to be able to pull that switch on what is a booming set of cannabis industries, really, that are greatly expanding into new products and greatly expanding in terms of firm size. And they're creating jobs everywhere, right here in Auburn and all across the country. The hemp and cannabis industries are creating jobs,
Mm-hmm.
Creating business. They're making people's lives better. And it's it's one of the great breakthroughs, really, that we've seen in the last 10 years. And I don't think that the Biden-Harris team will do anything against that, but they have in the past. And so this is one area where I'm hoping Joe Biden does change and change for the better, because that's really, we just got to get this country back to work.
Absolutely.
We've got to get people not locked down. We got to get kids back in school. We got to get people back to work, earning money, producing goods and services, because eventually that's what's got to take place. We can't remain locked down. We can't remain afraid to live. We need to sequester people who are in danger. But other than that, we need to return the economy to normal. And the key question, the key issue is we have to produce more goods and services for our own current standard of living, but also for things like the long-term problems of the national debt. The economy has got to get bigger to help solve that problem.
Yeah, and I think the amount of businesses shut down. I look out what's happening out here in California, and it's sad and scary because the big corporate chains manage to stay open, and all the little small stuff that really kind of makes my neighborhood unique, and it's probably the same for many of you living in different parts of the country, they're struggling and shutting down. And obviously we have to quarantine, we have to do whatever we can to protect ourselves, but a lot of these businesses being shut down, and that's not going to help with growth. The more that we shut these things down, the more we rely on government spending and these stimulus packages, which obviously is fake growth and not real. So going forward, guys, we'll have to wait and see how that all pans out. I'm optimistic. I'm trying to fake my optimism, but me and my apprehension towards needles and vaccinations. We'll see how this all goes. We saw Biden get a nationally televised shot today. That was rather entertaining. We'll see if Trump does the same thing. But hopefully this vaccine will get us back to where we can open up businesses and then get some of this new tax revenue pushed into infrastructure projects, maybe get some tax revenue from legalization of some of these drugs. But I think all of it's intended to get our economy back on track, which, judging by that national debt clock, we need to get it back on track quick.
Yeah, and Merlin, a very important point to make is that small businesses and new small businesses are the main driver of new jobs and for employment improvement prospects of individuals, especially those on the lower end of the income wage scale. So that's one of the reasons why we have to immediately address this problem of shutting down these small businesses, hair salons, nail salons, restaurants, roofing companies. All of these things need to be allowed to be back up. And my optimism comes from the fact that a growing number of people are realizing that some of these fringe leftist politicians in New York and California are a serious threat to our standard of living, and people are coming out in opposition. And that opposition is not just here in the United States, where it's very muted by the media, but it's also happening around the world, in the United Kingdom, in Germany, other parts of Europe, and elsewhere as well. So there's very large demonstrations that are taking place in opposition to this kind of left-wing thinking policy, suppressing people, suppressing businesses, closing schools, and running all the money through the government and through the hospitals and so forth. So hopefully we'll get up off of our backside, and more people will come to learn that these people are a real threat to our way of life.
Absolutely. Well, I've had this discussion, as I think we all have. It's become kind of the conversation du jour is, what are our thoughts on it? And to me, it's like I believe that the people should be able to make their choice. If I want to risk it, and if I'm unhealthy and I want to risk it and go to a business, then that should be my discretion. But I don't make the rules. I just have to abide by them. One of the questions that came through in the chat here just a minute ago was talking about debt to GDP ratio, and one of the comments, it scrolled up there quick and I may have missed it, but it was saying, we get debt GDP ratio under 100%, is manageable. We start getting higher than that, it becomes unmanageable. Japan's, I think, at 130. I believe as of today, according to the U.S. debt clock, we're at 144%. I don't know the Austrian School of Economics perspective of how impactful a debt to GDP ratio. So, John and Mark, do you guys have any input on that one?
Sure. That ratio of debt to GDP at 100%, that's a rule of thumb. It's not a law of economics, but it's a pretty accurate one. That if you go beyond 100%, it makes it increasingly difficult to continue to pay the interest on the debt. And consequently, your economy can move in a direction where it's less and less productive over time, where they do the wrong things, where austerity is applied in order to be able to make those payments. There's two types of austerity. One is where you raise taxes, and the other is where you cut government spending. And if a country doesn't cut government spending and instead increases taxes, the economy can collapse, basically.
Right.
And we've seen that in multiple cases throughout the European community and historically in the United States and elsewhere around the world. So it puts a country in a position where if you make the next wrong step, the economy melts down.
All right. John?
Well, I would parrot that same situation. Having debt as a percent of GDP is a function of where's the demand for the debt coming from. Look at the 10-year bond yield today, and look where it's been. The dollar, as long as the dollar is a reserve currency of the world, and you can print up dollars to cover the interest payment on your outstanding debt, perhaps it can go on and on and on for some period of time. But at some point in time, if the world loses confidence in the U.S. dollar as a store of value, a medium of exchange, and a unit of account, and I think you see some of that cracks in the plaster of the credibility of the U.S. dollar and all fiat currencies of the world. There have been many other countries that have had reserve currency status that lost it. Mm-hmm. What happened to their ability to finance and leverage their economies with the printing press? So just because the dollar today is still the reserve currency of the world, that doesn't mean it's permanent. And when you see fiat currencies fading in buying power relative to gold this year, relative to Bitcoin, and various other hard goods, even relative to copper, you can see that some fiat currencies are going to have a challenge. Some governments are going to have a difficult time refinancing their balance sheets. And is that possible in the United States? Well, of course it's possible. So
yeah, and investors need to realize that we're living through kind of an illusion where the Fed and other central banks have been keeping interest rates artificially low, practically zero. Some government bonds actually have negative yields. And even in Southern Europe, Greece and Italy and Spain and Portugal, the interest rates on their government bonds are incredibly low, breathtakingly low. And it's because the European Central Government, the European Central Bank has been absorbing more and more of that debt over time. So those interest rates are all an illusion, which keeps the illusion of the stock market high. But as John said, the value of the dollar can fall, and it has fallen noticeably recently. Mm-hmm. It was going for about an index value of 98 or 99, and I think it was 89.
90. Yeah.
90.
Yeah, it's at 90 right now. I actually got the chart up here for the viewers at home. Yeah, and that's ugly. I mean, that fall, it was actually at 102 back in March, almost 103. I mean, that's a precipitous decline for the dollar as a whole, which, of course, anybody that's holding U.S. dollars, this doesn't bode well for you traveling. Your purchasing power is getting annihilated as we speak. And that trend from a trader's perspective, looks like it's going to continue. We talked about a bounce potentially happening at these levels, which is fine, but we break that 2018 low, guys. There's a big potential drop here. I'll bring up the monthly for us so you can see the bigger picture. There's those lows from back in 2018. After that, you're talking the dollar index down at 80. That's a monstrous decline going forward just off of pure technicals, and I see no reason why that would be a far-fetched target to see it drop all the way down to 80 mark. I mean, given the fact that we're continually printing more money to buy back our treasuries, we're printing more money for stimulus, etc. I mean, it seems very plausible this dollar is going to continue to drop.
It does to me, and I think it presents opportunities for investors, though, because what we're seeing is a bounce of commodity prices, and it's really starting to look like it's across the board increases in commodity prices. I noticed this morning that the price of grains has increased by 25% since this summer, and of course, grains end up not just in your cereal, but also in the chicken that you eat, the beef that you eat. It's throughout the entire food sector of the economy, and the same is true with metals, precious metals, the soft commodities, coffee, tea, the base metals,
Lumber.
and lumber. Yeah, I don't know about the price of lumber, but it looks like there's an overall. Oh, is it?
Matter of fact, it's hurt the home builders. The price of lumber and copper are going through the roof, and that really impacts the margins for the home builders significantly this year. But lumber's going crazy. Can you pull lumber up on a chart on lumber, Merlin?
Can I pull up lumber? Does Howdy Doody have wooden feet? I got to change that one. Yeah, I'll bring up lumber here.
George Washington did.
Let's see. I'm hoping this might be the current this is the front contract here. So viewers at home, there's lumber. Now, of course, we had that huge drop in lumber back in September. I mean, it was a massive drop, but yeah, it's been on a rip roar. It's up almost 100% since the beginning of November. That's a double for, this is the Random Length Lumber's futures contract, but you guys are right. I mean, it's really rushing up, and of course that will have an impact on new home construction, which is also booming.
Yes, and I think this is just representative of an overall increase in commodity prices.
Yeah.
And silver is up enormously over the last 6 months or so.
I think it's the best performing metal for 2020. Sorry, Brendan, who's the big gold guy out there, but silver I think is actually doing the best. Bring up silver for us. We can see that one on the full chart over here. There we go. SI monthly had a pretty damn good 2020. It has fallen a bit, guys. You're at 26.39 right now, but I'll bring up the daily so you can see kind of how it's progressed this year. Similar picture what we saw with gold, just kind of a little bit of consolidation, flag pattern, if you will, but now maybe making a run at those all-time highs again. And again, cheap dollar means people can buy more of dollar-based assets going forward. My thought was on the dollar index. There was a comment earlier about stagflation, which of course is high inflation combined with high unemployment and a kind of stagnant economy. John, in the past you've talked about us being kind of more in a deflationary economy. Where do you think we stand now? Are we headed towards stagflation? Are we deflationary? What are your thoughts?
Well, there's some sectors that have been quite deflationary. I mean, look at the hotel sector. Look at what happened to the banks. Now, the banks caught a bid today because the Fed changed the rules last Friday. But look at the airlines. I mean, there are several sectors that have gone through a tremendous amount of pain. Now, a lot of that's been COVID related, but other sectors are booming. I mean, and there isn't much so I think you have to kind of look at it sector by sector. Notice that there's been a rotation, or at least the start of a rotation, out of the growth stock sector into the value stocks.
Mm-hmm.
And that's kind of new because value for the last decade has woefully underperformed growth. And but I think but if you look at in a real deflationary world, we should see the dollar growing in buying power. But as long as the Fed's going to keep their pedal to the metal, and the dollar index keeps declining in net buying power, it doesn't seem to me like there's a whole lot of deflation out there on the horizons. What do you think, Mark?
Well, I grew up during the stagflation of the 1970s, and it's not a pretty picture. And that form of stagflation was not really that severe. Inflation and unemployment rarely got over 10% each. It could get much worse than that, but it was a real terrible time to live through because you really saw and felt the impact of government. It's why I went on to become an economist, to study these issues. I found the Austrian school. The Mises Institute found me somehow. And, it's very enlightening, but the process itself was very painful because no one was getting a pay raise. So you were lucky to keep your job. And you saw prices from just about everything except real estate going up. So every paycheck, you could only afford to buy a smaller basket of goods. And also, of course, people would switch to a lower quality basket of goods. But the main point is you could noticeably see your standard of living going down because it was your paycheck, and retail stores and gas stations and other things where the pedal hit the metal. And so that's a very bleak outlook if that's the direction that we're heading.
Mm-hmm. I think it is. Who knows exactly where we're headed? I keep looking at these numbers, and I think when we had you on the program last time, I always like to, slam my fist at the table on the concept of inflation, because I go to the grocery store and I'm seeing nothing but higher prices across the board on almost everything I eat. And then when it's not a higher price, there's less volume of what it is that I'm buying. Like pretty soon, a dozen eggs will be 11 eggs. I mean, they've already taken an ounce out of some of my favorite beers. You're seeing used to be a 64-ounce carton of orange juice is now 58, and now it's the same price, but you've taken those extra ounces out. And I mean, we're seeing the housing market just vaulting to the upside. We're seeing home price appreciation vault to the upside, commodities running, and I'm running through going, what's going down? Right? Is there anything that's going down? And really the only thing out there that I can see that's going down is the dollar index, which of course we all know is a great fuel for those types of things. But what it does, in my opinion, is it just fuels the bubble. And of course, I've been saying we've been in a bubble for a few years now, and it's just kind of getting bigger and bigger and bigger. How does this all pan out in your opinion, Mark? We've got the dollar dropping, we've got the Fed printing, the government spending, markets all the time. I mean, it seems like this is like the roaring 20s from a market perspective, an economy perspective.
Well, it is. And pretty much everything is going up in price. Some of that is obviously the lockdown and the restrictions, which is preventing production. It's causing bottlenecks in production. It's causing bottlenecks in the transportation of products to market and from even Amazon to my house. So some of this could be easily swept aside simply by having a rational policy towards the virus, which we obviously don't have. But there's another real underlying problem, and that is basically of government fixing interest rates and causing the economy to become unbalanced, where stock prices go up, real estate prices go up, so eventually they're going to have to take away the fuel to this mania that they also experienced in the 1920s, and get back to the foundations. I don't see that happening. I think what's going to have to happen is that government is going to be forced to do so, and that more people have to become enlightened about free market economics. And unfortunately, I think we're going to see a lot of pain before that starts to take place.
Yeah. I agree. John?
I think there's another factor here that's going to be big in the coming year. Is just we have the duo of Yellen and Powell. I mean, this is like the super duo. Their track record is very well known. They're going to be super accommodating, and I don't think we've ever had this kind of condition where we're two deficit financing superstars can get to bat at the same time and complement one another. How do you feel about how they're going to act out in 2021, guys?
Well, I think you're right to bring that up. Yellen is an extreme dove, which means she's loath to raise interest rates under any condition. And so that's not a good side for reform. And Powell has shown himself to be an extreme dove as well. And so as we got closer to his target of 2% price inflation, he immediately shifted so that he wouldn't be constrained by 2% price inflation as is calculated in the Consumer Price Index. Mm-hmm. And so now he's looking at it more long term so that the CPI target can be overshot. And so he's shown himself to be a dove. He's done that time after time. And so we have two very people in charge of the nation's finances that don't believe in restrictions on printing money or spending deficits and selling government bonds in mass. And of course, the Fed is buying up a lot of the government debt that's being issued by the Treasury. So we're doing something that every textbook said the number one thing that you should not do is issue government bonds and then have the central bank print money to buy them up.
Right.
It's bad for a lot of reasons, and price inflation is one, but you're just sucking more and more real resources out of the economy and just inflating the burden of that away. But you're also hurting the economy taking those resources out in the first place.
Right. And I guess normally they wouldn't have to do it to the extent that they are, but when you have China and Japan, who are our largest purchasers of these securities, they're going, you know what, not only we don't want them anymore, we're going to sell the ones that we're starting to sell the ones we have. You got to find a buyer somewhere, and to me, it's the old analogy of the drug dealer getting high off his own supply. Here's our Fed to the rescue, saying, "Hey, what are you printing over there at the Treasury? Yeah, we'll take that, and we'll take 3 of these, and 8 of those, and 15 of these. Yeah, I'll make some money up out of nowhere." Crazy stuff. On the chart over here, guys, I brought up CPI because Mark mentioned that one. I thought it might be nice to look at the chart of CPI because you are all living at this point, and I don't see any dead voters in the crowd. But this goes all the way back to 2020. And you can see it's kind of peak based off of November closes here every 2 years. But, it's showing us about 1.7%, less than 2%, that inflationary target. And I just don't see it. I mean, look at the charts of commodity prices, your grocery stores. Something's wrong here. Mark, I don't believe this data adequately represents the world that I live in. You're an economist. How can this data not reflect inflation when I can bring up almost any item in my store and see prices are higher than this?
Yeah, I think they're playing games with the numbers, justifying those games as a result of the lockdown and COVID, because clearly prices across the board, I don't know exactly how they're rigging this, but they're obviously using rental prices, not housing prices, which is about 40% of the consumer price index, and the rest of it's hard to fathom. Although energy prices are relatively low as we speak,
right.
So that helps a lot. So you can juggle just housing costs with rental prices. Mm-hmm. And gasoline prices for energy prices, and that takes you, to more than 50% of CPI. But that's being highly selective, and they obviously must be playing some other types of games with other items that are in the consumer price index basket.
Yeah, I'm tweaking it right now and kind of adding on different things. It's actually, if you go to the BLS, which is the Bureau of Labor Statistics.gov, guys, they have a great chart here. You can see you're looking at a contraction on energy of 9.2%, and the food at home is, say it's up only 4%. I beg to differ with some of the food I'm eating, but Inflation. All right, let's go to one last topic here so we can get you guys out and enjoy some of the sunshine or the snow as it may be, depending where you're at. The last piece here is digital currencies. Now, we've got a lot of people asking about it. Most of my audience is in the positive camp with regards to cryptocurrencies and digital currencies. Let's start with the concept of your perceived impact of a Fed bank, a digital currency for the Federal Reserve, central bank backed.
Well, I think that's going to happen. And I think the fact that Bitcoin and other cryptocurrencies are so high is an indication of what a lot of market players are doing, and their concern about the stock market, the economy overall. So I think that's a good indicator of this delusion that we're living through. The Fed, the Treasury realize that they can't just stop and wipe out cryptocurrencies, that wouldn't be good for financial innovation. It's something that they actually realize, at least the smarter ones, that cryptocurrencies are a thing of the future. And if you don't liberalize your laws and restrictions, somebody else will. And so they know that, but they also know that they want to be able to control it to a certain degree. And so I think it's pretty much a given that the Fed and the Treasury are going to be interested in participating, and they also will be interested in regulating. And obviously, they're going to be interested in getting tax revenues out of cryptocurrency. If you bought Bitcoin at $20 and you just sold it for $20,000, the Treasury wants a capital gains tax on $19,000 odd dollars. So expect them to press forward in all of those areas, but not to the extent that was first feared, which was that the government or certain governments would completely obliterate cryptocurrencies.
Mm-hmm. Does it concern you that, so if the federal bank, let's say the Federal Reserve, issues their own digital currency, which I agree with you, I think it'll probably happen in the next couple years. This gives them a sense of an element of power that we've never seen before. So they can influence the money supply, they can work on interest rates, etc. But that doesn't let them know exactly what I'm buying and selling, where every single penny goes. Of course, we're all using Visa, MasterCard, American Express. Those centralized entities know exactly what I'm spending on, but at least the Fed doesn't know. When we get to a digital currency for a central bank, they now would have access to every single thing that we do transaction-wise. Does that scare you at all, that the fact that they'd have that kind of power and transparency into our lives?
Yeah, that does scare me. I think that does scare cryptocurrency investors, and I think that may be going a step too far as in terms of government intervention into these markets. So that may be a tipping point, stopping them from expanding and intervening in these markets too much. The participants are going to want any kind of federal cryptocurrency system to have most of the attributes of the private cryptocurrency systems. Mm-hmm. And so that might not take place.
Yeah. John, what do you think? I know you've been migrating over to the crypto bull side. From the Federal Reserve perspective, are you for it or against it?
Well, I'm for less government intervention and more individual responsibility. Crypto's done remarkably well on its own without a bunch of government intervention. Quite frankly, to go from fractions of cents per unit to over $20,000 a unit, it sounds to me like it's doing pretty well with no government intervention. And I think leave it alone. It'll seek its own level of valuation and transaction. We're seeing hedge funds get involved in it now. We're getting some very, very credible Wall Street pension funds getting involved in it. I saw some big wealth managers out of Chicago that are allocating over 10% of their assets under management to crypto. It's got its own futures contract. Look, Leave it alone. There is some. Just leave it alone. Let it do it. Let us do its thing. I mean,
it's important, and it's important for investors to realize. I'm not bullish on Bitcoin at these levels, but it's important for investors to realize that whoever developed this concept and turned it loose on the world was a fan of the Austrian School of Economics, was a fan of the gold standard, was a fan of free markets, not central banks and bailouts. And so this system was designed to act independently, like markets act independently, like the lumber market acts independently. Nobody gets to control the price of lumber or silver or iron or cornflakes. It's all done independently. So that's what scares governments, first of all, that this free market virus has been injected into the economy that they had just grown to control, basically, at a critical level.
Yeah. Well, time will tell going forward. I am definitely optimistic, and I'm long and strong on the crypto space. I am a little wary of the Federal Reserve getting their own digital currency. I'll still be using alternatives so they don't know every single transaction, but it was most likely going to be a part of our lives here going forward, folks. Mark Thornton and John O'Donnell have been our guests today. Mark, is there a site you want me to reference people to? Is it Mises Institute? We go to Mises.org?
Yeah, mises.org. It's one of the world's largest and most trafficked economic web pages. Of course, it's open 24/7, 365. You don't have to register to use it. We have an enormous library of books and articles and audio and video lectures on just about anything that might be tangentially related to economics. And it all comes from a very free market perspective, and I encourage everybody to go there. Our bookstore has lots of great stuff for low prices. When you get the sticker shock of college textbooks and bookstore books, and then you come to our site, you feel like if you're a reader, you feel like you're in a candy store as a kid. So check it out, especially over the holidays. We have articles coming out every day. We don't stop for Christmas. We don't stop for COVID. We were opened. We had our programs. They all came off extremely well. They were extremely well attended. Most of the off-campus events were maxed out, basically. And so, that's the way we've been operating, and we hope to use this lockdown virus contraption as a way of turning more people into knowledgeable people about Austrian economics.
Yeah, and he's also got his own books on there. The Skyscraper Curse, you guys see it. That's one of Mark's books. He's got a few others here. But I got the page up. You guys check it out, Mises.org. You click on books, there's a whole bunch of them. And if you are frugal, there's even free copies of different books out there. So, all right, guys. Well, thank you both for coming on today. I appreciate it. I like the format. I finally got my visuals worked out. Had a couple little visual glitches today, but we made it all work. So, Mark, John, thank you so much. Look forward to having you both back on soon.
Thank you, Merlin.
All right. Take care, guys. Have a good one.
Thank you. You too.
Guys, that was Mark Thornton, John O'Donnell. We talked about a lot of different stuff there. I wanted to kind of dive in deeper into some of these topics, but I wanted to kind of quickly graze across, macroeconomy, which I think hearing Mark's perspective is great. You also talk about the lockdown impacts and things like that. Good stuff. And I'm sorry, I know you guys saw some of the fonts moving around. That was a whole new layout I'm working with, so I apologize for me shuffling things around. The beauty of doing a live show, but hopefully I'll start to do that more. And I might, because of a couple cool things I discovered today with the software I'm using, I could probably have 3, 4, 5 people on the show. So maybe I can pull in some of my buddies here and have a nice big trading panel one of these days, which would be a lot of fun. Of course, you got to be PG-13 on those programs. You never know what's going to happen. Brendan, I got to say real quick, did you send some cryptocurrency to an address that wasn't yours? Did you really do that? I'm hoping, fingers crossed, it wasn't a lot, because that's never coming back, right? It would be kind of nice if all of a sudden somebody saw it and went, oh no, that wasn't meant for me, and sent it back. Yeah, unfortunately that doesn't happen. Too bad. All right, what else do I got for you guys today? I wanted to bring this chart up just real quick. This was, I meant to bring it up during the show, but of course I'm trying to do 50 things at once, and that's why I have mistakes on the program, but hey, I'm only human. You notice this chart here, this is the M1 money stock. This is basically the money that's in circulation. And the reason I think this is so fascinating is if you go back into 2009, when we really started QE, we were about $1.4 trillion, right? I mean, not that big of a deficit, or sorry, money supply. But now you look forward, and from 2009 to 2019, we went from 1.4 to about 4. So this next jump up here, and I think I actually have a pen that I can draw on the screen with, because this is just crazy to me. In this window of time where I have this little red box now, kind of reddish box, try to make it look like a box. Well, it's a UPS box. It's kind of smashed. It was square, but UPS got a hold of it. Now it's all crushed. That's 4, right? So we've jumped $2.6 trillion in a decade. Okay, not that bad. Well, now all of a sudden we've gone from 4, and this is actually not even including through till today because we're past the 7 trillion mark. We've jumped over $3 trillion in less than a year. I mean, this is the definition of parabolic, and it's really scary to think what the impacts of this might be. And we talk about the devaluation of the U.S. dollar and the dangers that can have. Right now, it's a beautiful thing for the markets because it's pushing the dollar lower. You're seeing this inflation of bubbles, whether it's housing, equity, bond markets, or even commodities. These are just all pointing straight up right now. And of course, my years of trading have told me when something goes parabolic, there's usually a big, sharp move back. May give all of it back, may give a portion of it back, but there's that knee-jerk reaction. And I think systems are set up that when panic selling comes in, you're going to see a much bigger move to the downside. So we'll have to wait and see what the final outcome of all this is. I, for one, am waiting with rubbing my hands, kind of excited to see how it pans out, and hopefully I'll be able to capitalize on it. And it's going to be nuts. Big Eb said, what is it, like 20% of all? Yeah, I think so. I think it might even be higher than that. For those on the podcast, Big Eb says it's like 20% of all dollars ever printed were in 2020. It actually looks like more than that, because if we've gone from if you look at this chart here, if we've gone from 4 trillion to 7 trillion, that would be about 40% of all dollars in circulation around the world were printed this year. That is freaking scary and crazy at the same time. Bizarre stuff. The world we live in, but hey, the markets are doing great, right? Keep on staying long and strong and bullish to the upside. All right, let me show you just one of the things that's happening tomorrow. There's really nothing going on tomorrow from an economic perspective. I actually thought that we'd see more of a meltdown on Tesla today. It sold off a little bit, but not dramatic. At one point, it was down about 6-7%. I still think you got some big downside move as there's not much left to help push Tesla to the upside. Here's our economic calendar for tomorrow. Now, this normally would be a big announcement. It's the final GDP number. It's really not much to worry about because the advanced GDP pretty much told us what this was going to be. So I don't expect a big market reaction to the USD numbers tomorrow. This happens 1 hour before the markets open. Will be final GDP and GDP price index. Now, 30 minutes into the trading session, you have consumer confidence, existing home sales, and Richmond Manufacturing Index, which has been dropping and looks like it might continue to drop. That is what is happening for the U.S. markets. I'll put a red box around those. For the other parts of the world, not too much. You've got the euro down at the bottom. That'll be late tomorrow night. German import prices. Other than that, not too much going on. And my friends, is your wrap up, I guess. And I managed to real quickly bring it back to a under an hour show, much to your dismay. Now for tomorrow, Jeff Manson. I just did an interview with Jeff Manson for Online Trading Academy. He's got a new signature series starting in March for Online Trading Academy, talking about training your eyes. Of course, those that know Jeff know he's big into pattern recognition. He's big into structure, kind of historical patterns and trends, as well as looking at things like Fibonacci and many other indicators. So we'll be talking about that with Jeff Manson tomorrow. If you guys have something you want us to talk about, well, let us know. Send me those comments and questions. You can go to TraderMerlin.com. That's an easy way to do it. You can, my numbers are all switched up here. Let me just, I added in 4 different scenes today for the show, and I forgot where I put my, well, I won't put up the flames anymore. I don't know where those went. But if you have questions, send them in to TraderMerlin@gmail.com. That's the easiest way. Best way, which helps me out the most, is put comments and questions below the video, and I'll get to all those. Tomorrow will be Jeff Manson. I'm going to do a show by myself on Wednesday. I'm not sure if I'll do one on Thursday, but Wednesday I want to get to a couple of crypto questions, which people have been asking me a lot about, and I just haven't had a chance to answer those. So I will do my best to get to all those. So that, my friends, will do it for today. Hope you enjoyed that session with John O'Donnell and Dr. Mark Thornton of the Mises Institute. You can go to Mises.org to find out more information. He's got a ton of information out there, books and writings all the time at Mises.org. All right, that's going to do it, everybody. Hope you guys have a fantastic day tomorrow. Remember, volume's probably going to be very light. Historically, this is one of the lightest weeks of the trading year is Christmas week, and then next week it picks back up. Also, did you know that the last 5 days of the year and the first 2 days of the year have a positive return about 1.3%. Just throwing weird statistics out there. We still got another week to go. Anyway, hope you guys had a good show. I'll talk to you tomorrow. Take care.